Welcome. I'm Terry Heymann, CFO at the World Gold Council, and I'm delighted today to be speaking with Reid Steadman, who is the Global Head of ESG and Innovation at S&P Dow Jones. Reid is based in New York City and has previously spent time in Europe and in Asia, including a stint as an economist for the US government. Reid, welcome and thank you very much for joining us.
It's great to be with you, Terry.
So Reid, we're sitting down in literally the final hours of the COP26 talks in Glasgow. A really big, important event, and I think everybody's eagerly waiting to see the final document that comes out there. What do you see as the major themes emerging from this conference over the last couple of weeks?
There's been a tremendous amount of news coming out of COP and a lot of focus on the involvement of Russia and China in various agreements. But there really has been one major emerging theme that has come out of it from our perspective, which is the importance of nature. The idea that it's not enough for us to simply not pollute, but that there should be an active engendering of a positive ecosystem that would be supportive of many different industries, communities around the world. And so we've seen some big commitments in this area. 33 financial institutions came together to commit to phasing out deforestation from their commodities portfolios. These institutions together represent $8.7 trillion in assets under management. And we really see this as a natural progression from, again, that idea of just avoiding certain pollutants to really going to more of a positive impact story of driving strong biodiversity, again, a natural ecosystem that is going to be supportive of positive growth around the world.
And that's a really interesting change, I think, of this explosion and attention around ESG, around making an impact. Talks a lot around forestry and nature, and I think we're going to see more of that. And then we're going to see more funds that are linked explicitly to an ESG agenda, where there is a very clear label that this is an ESG fund. I think the data shows something like AUM in these funds is up to around 250 billion as the beginning of Q1 in 2021, up from around 10 billion, 2015, 6 years ago. What do you at S&P define as your ESG priorities, and how is that changing? And I guess linked to that, what do you see on the global perspective in terms of different evolution in different geographies? Is Europe ahead of the US?
Yes, so things are evolving quite quickly. We launched our first sustainability index in 1999, the Dow Jones Sustainability Index. And that index was built with the idea of simply highlighting companies that were doing well from a sustainability standpoint. But it really wasn't built with the idea of asset management in mind, actually driving investment. And in the past few years, that's what we've seen is the emergence of these types of indices, types of fund strategies that aren't meant to have to be used, say, in the satellite area of a portfolio allocation in the niche area, but are actually targeted at the core of a portfolio to be used for the core part, the majority of a portfolio. And if you look at, say, our indices, a really good example of this is the S&P 500 ESG index, which is a sustainability variant of our most popular index, the S&P 500. And the philosophy here, instead of looking at a very narrow set of companies, this index goes broader. So it includes more than 300 of the original 500 companies. There is an intentional balancing of the companies among the different sectors in the S&P 500, the different industries. And because it's balanced, you end up having an index that is very benchmark-like in its risk and return profile. And what that enables, what that facilitates, again, is using that index for portfolio management, for portfolio measurement, not in a niche area, but more in the middle of the portfolio. And this is what's driving that huge increase in assets that you just talked about, Terry. In terms of the different markets and where there's interest, there's no doubt that Europe is still the leading market for ESG. And there are many reasons for that. But most recently, one of the biggest drivers is how active regulators have been in defining what a sustainable fund looks like. So there's regulation emerging called the Sustainable Finance Disclosure Regulation that speaks about what a fund would look like that's not greenwashing but is driving for an impact. There are other regulations that are benchmark specific. So they took on the task of defining what a Paris-aligned index would look like. And these efforts have been very powerful in coalescing a view that the market has taken on in terms of how to approach sustainable investing. That said, other markets can very quickly catch up. The U.S. is starting to really focus in on sustainability as well. And the U.S. market is incredibly efficient and more flat, I would say, in terms of how quickly different themes can be adopted. And so even though the U.S. is a little bit behind Europe, it has the potential to very quickly catch up.
I think that's right. And I think we're seeing this mainstreaming globally across different asset classes and really very serious integration of ESG as part of an overall portfolio, not an add-on. In that context, and now that we are at the end of COP and all of this attention on climate, what are your thoughts on climate investing and what investors can be doing around developing their portfolios in terms of recognizing and incorporating a climate perspective?
Well, I'm going to give a little bit of a technical answer, but I'll explain it. What investors can do is think in industries. So, in the older days when sustainable investing started, there was a very kind of simple approach to ESG investing, sustainable investing, which was simply to carve out large groups of companies, carve out the energy sector, carve out utilities, and then invest in everything else. But more, we're seeing that investors are taking a more nuanced approach, which we feel is a really great advancement for ESG, which is to stay engaged with companies, but to reward and penalize them based upon their sustainability performance by increasing their weight or lowering their weight within the portfolio based upon their performance. But that performance isn't just, say, overall against all companies. It's really appropriate to look at companies within their industry groups, look how they're doing relative to their peers, because it really isn't fair to say, take an energy company and compare it to a media company or a tech company and compare that to utilities, right? I mean, they're very different businesses that have very different impacts from an ESG perspective. And so companies need to be analyzed, within the context of their peers. I would say another development that we're seeing is more interest in the trajectory of companies. So it's not enough to be doing well today. We need to see which direction companies are going and whether they're really moving toward that goal of a net zero approach. So we need to understand how a company was doing last year, how they're doing this year, and the direction that they're heading for next year.
I think that's a really important point. What is the roadmap to decarbonization, and not just a point in time, but how can investors help drive that decarbonization through where they direct capital?